ask me how I know. Sell your truck while it's still running.
Hey Facebook, YouTube, wherever else you're watching this video, we're glad to have you back again. This is our third video that we're doing. And so my name's Scotty Lovett and I'm with Integrity Mortgage.
My name's Jody Kennedy and I'm with Century 21 Judge Fight.
And we're glad to have you again watching these videos. Again, just as a reminder, if you have questions, comments, topics that you'd like for us to go over, please make sure you're either commenting below or sending us an email directly so that we can make sure that those are potentially future videos to address any concerns.
Absolutely, and make sure that you subscribe and like our channel.
Yep.
So that we know you're watching, and we enjoy putting these videos out for you guys.
Perfect. So what's the topic going to be today?
Okay, so our last video we talked about foreclosures.
Yep.
And along the lines of foreclosure is how do you improve your credit score?
Yeah. So of course, when I, as a loan officer, I'm looking at a client's profile, there's three things that we look at. It's credit score, debt to income, and loan to value. And the most important thing when we're starting out to even determine where we can go is the actual credit score. Because the credit score is actually telling us as the lender, how are you going to handle your finances once we give you this loan? So we're always backwards looking. And so there's things that we can do as a lender to help you improve your credit, or things that you need to be looking for so that when you're making your financial decision, you've already got these in the back of your mind, so that if it's 6 months from now, if you watched our video, you can be like, oh yeah, well, they talked about doing these things. So the first one, of course, is make your credit card payments on time, or whatever it else might be, auto loan, another sort of short or long-term liability. Make sure you're making all your payments on time. That does not mean that you have to pay in excess of the minimum payment, but don't miss a payment. Once you go over 30 days, your credit score will take a major hit. And it's something that you can't do anything about removing that. It just is on there until enough time has elapsed that it will improve your credit score. So
how long does it take for those hard hits to fall off?
Like a actual because you missed a payment scenario. So some of these can take up to 7 years before the actual credit bureaus will remove them off. Really? And so that's why it's so imperative to do that. And then if you do realize that you're running up into a scenario of maybe, again, kind of like what we were talking about in the last video, your income's getting tight or whatever it might be, make sure that you're doing everything within your power, because if you do decide to buy a house, buy a car, whatever, these decisions you're making today could impact you 2 to 3 years down the road.
When you're ready to buy.
Yeah. So then the other one is paying down debt. I, as a lender, we're looking at debt to income, and we don't ever want your income versus your debt obligations. We typically don't want that to go over 43%. Now, there are loan programs that are out there that will go all the way to 50%. So just to give you easy math here, you make $1,000, your new mortgage payment, and if you've got an auto loan, those payments can't be in excess of $500, because once you do that, you're going over 50% debt to income.
Okay, so that would be mortgage, car payment. Is anything else?
So credit cards, student loans,
hospital bills.
So medical collections. Now, if you have anything that has a minimum monthly payment that would show up on a credit report, or even if, let's say that you've got a note receivable from a friend, like say I bought a car from you, but you didn't put it on the credit report because the car's in your name, but we wrote an agreement between each other and I owed you $300. That actually, as a lender, I ask in our loan application, is there any debts that aren't going to show up on a credit report? You should make sure you're including those things, because if we find out later that there is a $300 payment that you're having to pay that's not showing up on a credit report, that could potentially derail you getting your house. And you might be already under contract about to close, and all of a sudden now the whole deal falls apart.
Yeah.
So these are things that we are looking for, and there's reasons behind our questions on making sure that we're accounting for all debt. And then opening new lines of credit. So this is a topic that I do have to have with a lot of people that are just trying to get established. Like they haven't had credit cards in the past. Maybe they just are getting out of school. We'll just use that as an example. Just getting out of school, never had credit card debt. But you got to start establishing credit, because that's the only way that we know that you're going to be able to make payments, because we're always looking back historically. And if you don't have a credit card, sometimes it's hard to go get credit cards, because a lot of these credit card companies go, well, we don't have a history to be able to
Yeah,
determine.
you don't have a FICO score.
So what I end up talking to people is, find a credit card where maybe you put a minimum down of $500, and that all that is you're putting cash of $500 down, and you're getting a credit card for $500. So if you ever don't make the payment, they're holding your $500 cash as collateral. But that allows for you to start establishing that credit so that you can build up that history.
So when I graduated high school and I first got a credit card, then I went and got 10 credit cards. And I always made all the payments,
right.
Which, you know, it's enticing when they say, you know, you'll get 2% off or whatever. And so I had like Bed Bath & Beyond, Home Depot, all these. But that can actually hurt your credit, right?
It can, because once you start getting too many inquiries, because all credit cards or auto loans, all of those, they're going to do a hard inquiry on your credit report. So if you go out and you apply for 10 of them in 30 days, 60 days, 90 days, all those hard inquiries start adding up. And eventually these creditors, the credit bureaus, so the Experian, TransUnions, and Equifaxes of the world, they start going, well, this person might be over leveraging themselves, taking on more debt than they probably should. As a result, your credit score goes down. And that's a way for them to kind of pull you back from being able to go out and buy more things, because eventually then when somebody pulls your credit, they go, ooh, your credit score's down. We're not going to be able to lend you any more money.
You know what? It's kind of crazy to think that we have these legislative rules in place to protect people from getting into a foreclosure situation.
Yeah.
So it's, I mean, as annoying as underwriting is, it serves its purpose of protecting you. Yeah,
because we don't want to give out a loan to somebody and all of a sudden 6 months from now we're getting a phone call going, we just got foreclosed upon. Because whether my clients want to be my friend or not, my goal is to try to become friends with my clients. And it would be something that would keep us up both at night going, well, crap, our client just lost their house. And then I'm going, crap, I let a client get a house that they shouldn't have gotten into because they weren't, you know, ready to take on that financial responsibility. Or maybe I just didn't educate them enough. You know, those are the things that go through my head. And so there's a lot of stopgaps on things that we're looking at from a credit score standpoint to either be able to educate our clients and bring up things that maybe they're just not aware of, or it's something else where it's, hey, we got to work on your credit for the next 6 months to get you ready to buy a house. And those are things that we do try to make sure that our clients understand. Just because you're not ready doesn't mean that we don't want to continue working with you, because ultimately we're here to help you achieve your goal. And if that's your goal is to buy a house, some of the most rewarding experiences for me are the people that I've worked with for 6 months, and then all of a sudden they get their house and they go, I couldn't have done it without you, because I wouldn't have thought about paying off that medical collection, or I wouldn't have worked on bringing down my credit score or my credit card balance, because before I was almost at 100% usage. Well, you told me, Scotty, to bring it down to 30% and maintain it there for about 3 to 6 months, and all of a sudden my score went up because...
Yeah, I have a question on that. So let's just say you have, I read that, 30%. I put everything on my credit card, but I pay it all off at the end of the month. But is that hurting me? Like, I mean, maybe, you know, if I have a $10,000 limit and I'm putting $8,000 a month on the card, but paying it off, should I try to keep that down to like $3,500 on the card?
No, so it's not. So when you're trying to establish credit, like if you don't have a credit score, then yes, you do want to leave some money on your credit card each month so that you can show that you can maintain it and properly use it. But once you've established credit, and let's say that you've had now credit in your name for 10 plus years, then at that point it is perfectly fine if you go and use the credit card because maybe you're getting points or whatever it might be. You're getting your points, and then at the end of each month you pay it down. Again, it's showing that you know how to properly use and utilize your credit limits, because you're not always going out there putting $8,000 on it and then you let it sit out there for 6 months and then you're not making more than the minimum payment and it's really not coming down. You're actually using your credit card but then paying it off each month, which shows that you're being financially responsible because you're not over leveraging yourself.
Okay.
Because you know you have the financial capacity to pay it off each month.
Gotcha.
Again, I'm not saying you have to pay it off each month, but if you are going to have a credit card open, just make sure that you're not letting it sit out over 30% usage. So $1,000 don't have more than $300 sitting out.
And then make the minimum payment and keep it at 30%.
Yeah, exactly. And it's good to see actual usage too. Don't just go get a credit card, use it one time, and then be like, okay, that's it.
Right. Yeah, and it's also good to keep them for a few years, right?
Oh, exactly. So I try to tell people when we're trying to help them establish it is go find something that you do frequently. And the most frequent thing that we do, at least here in Texas, is we drive our cars. So I say go get a gas card, because you know every couple weeks or every week you're going to be filling up your car with gas. So that's a good way to use it and then pay it off. Use it and pay it off. Don't go get a Best Buy credit card, because you're not going to be buying TVs every week.
That was one I had too.
Yeah, exactly. So
I did buy a lot of stuff though. I paid it off.
And so let's see. So we talked about the hard inquiries.
And this is a question I'm sure I've asked you in the past. Hey, I'm going to do a refinance.
Mm-hmm.
Does that hurt my credit to do that soft hit? Or is that a hard hit?
So whenever we are looking at doing a loan for somebody, we actually do a hard inquiry. And the reason for that is we need to see everything that is out there that you potentially have a liability against you on. But the thing is, a credit inquiry for a mortgage is viewed differently by the credit bureaus than if you're just going out and getting a bunch of credit cards. So if you went out and got 3 new credit cards today, your score is going to go down from what it was the day before. But they do view a mortgage as a different thing, because it is an actual asset for you. It's something that typically appreciates in value. It's something that I always equate it to, it's like a 401k. You're paying into it and it's going to continue to typically grow in value, and then whenever you're ready to get out of it, you pull all your equity back out of the house. So that's why the 3 credit bureaus look at it differently than, say, a credit card, because that's just new debt that you're taking on that's a liability that you could potentially get yourself into a big financial problem. And a car is a depreciating asset. Now, I know some of y'all might go, well, yeah, but there's some cars that actually go up in value, and most people aren't buying.
Yeah, my husband likes to tell me that about diesels.
That's what I was going to say. I figured your husband would be like, oh, well, Scotty, wait a second. There's a lot of cars I like that actually go up in value every year. And so that's something that you don't have, because a car is going to depreciate in value. Those things actually do pull your score down. So again, it's very important to keep credit score top of mind when it comes to getting ready to buy a house. And that's either starting to prepare to establish it, fixing it, or maintaining what you've already got. Because it's very easy to forget and miss one payment, and you could be at an 800 credit score, and the next day you look up and now you're at a 700 credit score. And not that that's a bad credit score, but you could be impacted because of one 30-day decision that you made.
And then your credit score ultimately affects your interest rate, correct?
Correct. Because when we're doing loans, we are looking at you as a risk factor. And the less risks that we can see, and that's again through credit score, how much you're putting down, and your loan to value, and your debt to income. Those things, when we're looking at that is determining if you're on the less risky side or the more risky side. And the more risky you get, the higher the rate ends up going. And so that's why I always am trying to educate my clients, especially if they go, hey, I'm not ready to buy for 3 to 6 months. it's still a good time to go ahead and get your loan application in, because if there's something that we can work on for the next 3 to 6 months, wouldn't it be nice to find that out now and us get your score up over that period of time, so I can say that your interest rate just went down as a result? So again, it's not too early to start having those conversations now, even if you're not ready to buy just yet, because long term, most people don't go, hey, I'm going to go on a vacation, and they wake up the next day and they get on an airplane and just go to wherever they're going to go. Most people start planning it out, and they end up budgeting it. They end up planning where they want to go stay, what the things they want to go see while they're there. It's the same thing on getting a house. You don't just wake up and do it one day. You need to start planning these things so that whether you're ready to buy and close on a house in 30 days, or if you're ready to buy and close on a house in a year from now, you still need to get your plan in place. So that's what I try to educate my clients, is making sure they understand we're here to help you navigate that journey to home ownership.
Have you ever heard of something called Experian Boost?
Yes, so I have heard about that. I've had people tell me that they've applied for it through their website, and then whenever I go to do it, it doesn't show up anything on my side. So I think it's through a different FICO scoring system.
Okay.
So I do see that pop up. People are like, oh, I just did the Experian Boost, but I don't see it when I do my inquiries on my side. You actually made me think of one more thing that I wanted to bring up, and a lot of people will probably ask you these questions, is, oh, I pulled my credit on Credit Karma and it said I'm X, Y, or Z on my credit score. Credit Karma is not a hard inquiry on your credit report. They are taking just the general information that they can find out there in the market and trying to determine what your credit score is. And unfortunately, it ends up leading to their expectation of their credit score and what I actually see are different. And Credit Karma is just really a data aggregator where they're pulling all your information off when you log into their website for cookie purposes to send you information, be it's Amazon that you want to buy this thing, whatever it might be. But Credit Karma is a good tool to start determining, okay, are you in a good credit score range? Are you in an okay credit score range? Or are you in a bad credit score range? And then from there, then we can start figuring out where to go. So now
what's the minimum score, let's just say, for the highest interest rate mortgage? Typically.
So at Integrity Mortgage, our minimum credit score is 620, but that does require a credit committee decision. So that's not just me going, okay, it looks good. We have to go and have our head of operations, our underwriter, and the owner of the company evaluate the overall profile to make sure that we deem that the person is creditworthy to get the loan. Now, 640 and above, then there is no credit committee. At that point, you do meet the minimum standards that are set forward by our company to determine that you are creditworthy to qualify for one of the loan programs that's out there.
Now, okay, so if I have a client with a 640 credit, are they going to have to put down a larger down payment than somebody with an 800 score credit?
No. So because there are, and we've talked about this in some other videos, is there are different loan programs that are out there. So if you come and apply for a loan and you want to put 5% down, but you're at a 640 credit, and then you come and apply and you're at an 800 and you want to put 5% down, the two different programs that we're going to be looking at is the individual with the lower credit score. We're probably going to be looking at an FHA loan because, again, the government's stepping in to protect us should there be a risk of default. And as a result, that FHA loan does allow for us to give a loan out with very similar interest rates, if sometimes not better. The only difference is between the conventional and FHA is that the FHA does have a funding fee, and that's how FHA continues to lend out money to these individuals, and it also protects them from eventual defaults because unfortunately when people get money, there's always going to be the potential risk of a default, and it ties back into what we talked about in the last video, unexpected circumstances that can occur. So
cool.
Yeah. So we hope that you're liking these videos. We're having a good time doing them.
Yeah, we enjoy it. It's kind of nerdy stuff, but it's really important stuff. So we just want to help educate you guys and.
Yep.
Might have to edit that out. Okay, there we're
hey,
back.
And we're back. Hey, technical difficulties, but it's all right. So,
yeah, so thanks for listening to us, and we look forward to our next video.
Yep, and we'll see you then.
Bye.
Cheers.